December 30th, 2025. Silver closed at $29.87 per ounce, down 43 cents from Friday's close, down 1.42% on the day. But here's what matters. We're sitting at a critical technical level, and what happens in the next 72 hours could determine the entire trajectory for the first quarter of 2026. Let me show you exactly what's happening right now. The price action today, the fundamental drivers moving the market, the technical levels that matter, and why the setup we're re-seeing is almost identical to 3 previous moments in Silver's history, where massive moves followed within weeks. This isn't speculation. This is pattern recognition. And the pattern is screaming that something is about to break. The price action today was revealing. Silver opened at $30.15, tested resistance at $30.30 in early trading, then rolled over. By mid-morning Eastern Time, we'd broken below $30. That's psychologically significant. Round numbers matter in commodity markets. $30 acts as both support and resistance. When we're above it, bulls are in control. When we're below it, bears have the momentum. The selling accelerated into the afternoon. No single catalyst. No major news event. Just steady selling pressure. We touched an intraday low of $29.72 before a small bounce into the close at $29.87. Volume was moderate. Nothing extreme. But the pattern is what matters. This is the 4th consecutive session where silver has failed to hold gains above $30. We've tested it repeatedly. December 23rd, pushed to $30.45, rejected. December 26th, rallied to $30.28, sold off. December 27th, touched $30.35, couldn't hold. Today, opened above $30, closed below it. When you see repeated rejections at the same level, it tells you something. Either there's massive selling waiting at that price, or buyers aren't willing to chase above it. Either way, it's resistance. And resistance holds until it doesn't. Now, let's talk about what's driving this price action. Because silver doesn't move in a vacuum. 3 forces are converging right now. First, the US dollar. The dollar index closed at 108.24 today. That's up 0.35% on the day. And it's the strongest the dollar has been since November 2022. When the dollar rallies, commodities denominated in dollars typically fall. Silver, gold, oil, copper. They all move inversely to the dollar most of the time. Why is the dollar rallying? 2 reasons. First, U.S. economic data continues to show resilience. The Atlanta Fed's GDP Now model is tracking 4th quarter growth at 3.1%. That's stronger than expected. Strong U.S. growth means the Federal Reserve has less pressure to cut interest rates aggressively. Higher interest rates support the dollar. Second, global risk. There's growing concern about economic slowdowns in Europe and China. When global growth slows, capital flows to safe havens. And despite everything, the US dollar remains the world's primary safe haven currency. So money is flowing into dollars, pushing the index higher. This creates headwinds for silver, not insurmountable, but real. As long as the dollar is strengthening, silver faces selling pressure. The second force is real interest rates. The 10-year Treasury yield closed at 4.58% today, up 4 basis points. That is, the highest level since May 2024. But inflation expectations measured by break-even rates are around 2.3%. Subtract inflation expectations from nominal yields and you get real yields. Right now, real yields are approximately 2.28%. That's significantly positive. Why does this matter for silver? Because silver pays no yield. It's a non-producing asset. When real interest rates are negative, meaning inflation is higher than interest rates, silver becomes attractive. You're losing purchasing power, holding cash, so you hold silver instead. But when real interest rates are positive, cash earns a real return. Silver doesn't, so capital flows out of silver into interest-bearing assets. The rise in real yields from near zero in 2021 to over 2% now is one of the primary reasons silver has struggled. We peaked at $30.35 in May 2024. Then again at $34.87 in October 2024. But we've failed to break decisively higher. Real yields are the anchor holding us down. The third force is industrial demand uncertainty. Silver is unique among precious metals. Roughly 55% of demand comes from industrial applications: electronics, solar panels, electric vehicles, medical devices, 5G infrastructure. These industries consume massive amounts of silver. But there's growing concern about global industrial production in 2026. China's manufacturing PMI has been contracting. European manufacturing is weak. The US is resilient, but not booming. If industrial production slows globally, silver demand falls. And with supply relatively stable, lower demand means lower prices. Recent data shows Chinese solar panel production slowing. Electric vehicle sales growth is moderating. These are silver-intensive industries. Growth rates decline, silver consumption declines. The market is pricing in this risk. So we have three headwinds: strong dollar, rising real yields, industrial demand, uncertainty. All three are pressing on silver right now. That's why we're seeing repeated failures at $30. But here's where it gets interesting. Because the technical setup we're in right now has appeared 3 times before in silver's history. And all 3 times, what looked like weakness turned into explosive moves higher within weeks. Let me show you the pattern. The pattern is this. Silver consolidates below a major resistance level for weeks or months. Multiple tests, multiple rejections. Everyone assumes resistance will hold. Then suddenly, one test breaks through. And once it breaks, the move is violent. The first example is 2010. Silver spent most of early 2010 consolidating between $15 and $18. Multiple tests of $18 resistance, each time rejected. Traders assumed $18 was the ceiling. Then, in September 2010, silver broke above $18. And it didn't just break, it exploded. From $18 in September 2010 to $49.82 by April 2011. That's a 177% gain in 7 months. The consolidation below $18 wasn't weakness. It was accumulation. Big players were building positions. And when the breakout came, there was no supply above resistance. Prices gapped higher. The second example is 2016. Silver spent early 2016 consolidating between $14 and $16. Multiple tests of $16, each time sold off. Then in April 2016, silver broke above $16. From $14.60 in January 2016 to $21.23 by August 2016. That's a 45% gain in 7 months. Again, the consolidation looked like weakness, but it was coiling, energy building, and when it released, the move was fast. The third example is 2020. Silver spent March through June 2020, consolidating between $15 and $18. COVID had crashed markets. Silver fell from $18 to $12 in March, then recovered to $18 by June. Multiple tests of $18 resistance. Then July 2020 arrived. Silver broke above $18 3 times. Same pattern. Consolidation below resistance. Multiple tests, then breakout. An explosive move. Right now, we're in the same pattern. Silver has been consolidating between $28 and $32 since October 2024. We tested $32 in late October. Rejected, we tested $31 in November. Rejected, we tested $30 multiple times in December. Rejected every time. this looks like weakness. But if history is any guide, this is accumulation. This is the setup before the breakout. And when the breakout comes, if it comes, the move could be significant. Now, I'm not saying it's guaranteed. Patterns don't guarantee outcomes, but the similarities are striking. And if you understand the pattern, you can position accordingly. Let's talk about the technical levels that matter right now, because silver is sitting at a critical juncture. Support levels. The first support is $29.50. That's the December low. We tested it on December 19th, held. If we break below $29.50, the next support is $28.70. That's the November low. Below that, $27.50. That's the October low. If we cascade through all three, we're in trouble. It means the consolidation has failed and we're heading lower. Resistance levels. The immediate resistance is $30. We know this. We've tested it 4 times in the last week. Can't break it. Above $30. The next resistance is $30.85. That's the December high from December 12th. Above that, $32.03. That's the November high. And above that, $34.87. That's the October high and the 2024 peak. If we break above $30 and hold it, we're targeting $30.85. If we break above $30.85, we're targeting $32. And if we break above $32, we're likely going to test the October high at $34.87. Each level acts as a magnet. Price moves from level to level. But the key right now is $30. As long as we're below it, momentum is negative. Once we break above and hold it, momentum shifts positive. That's the inflection point. The moving averages tell a similar story. The 50-day moving average is at $30.92. We're below it. That's bearish short-term. The 200-day moving average is at $29.15. We're above it. That's bullish long-term. So we're caught between the two. Short-term, bearish. Long-term, bullish. Neutral in the middle. When price is caught between moving averages like this, it usually resolves violently in one direction. Either we break above the 50-day and rally, or we break below the 200-day and sell off. The consolidation ends with a breakout or breakdown. The RSI, Relative Strength Index, is at 48. Neutral, not overbought, not oversold. Room to move in either direction. This is actually constructive. If RSI were at 70, we'd be overbought and vulnerable to sell-off. If it were at 30, we'd be oversold and due for bounce. At 48, we're neutral. The next move could be big in either direction. So the technicals are coiled. We're at support, below resistance. Moving averages squeezing. RSI neutral. This is textbook consolidation before a major move. Now, let's talk about the fundamental backdrop. Because technicals tell you when. Fundamentals tell you why. And the fundamental setup for silver is unlike anything we've seen in decades. The supply deficit is real. According to the Silver Institute's latest data, global silver supply in 2024 was approximately 1.01 billion ounces. Demand was approximately 1.21 billion ounces. That's a deficit of 200 million ounces. The 6th consecutive year of deficit. Where's the shortfall coming from? Above-ground stockpiles. Inventories held by governments, institutions, and exchanges. These stockpiles are being drawn down to meet demand. But stockpiles aren't infinite. At current draw rates, visible inventories could be depleted within 3 to 5 years. Mine supply isn't increasing. Primary silver mines are declining, or grades are falling. New discoveries are rare. And most silver, roughly 70%, comes as a byproduct of base metal mining. Zinc, lead, copper. When those metals aren't profitable to mine, silver production falls too. And with base metal prices weak, miners are cutting production. Recycling isn't filling the gap. Only about 15% of silver used in industrial applications gets recycled. Electronics contain tiny amounts of silver. It's not economical to extract. Solar panels lock silver away for 25 to 30 years. When they're decommissioned, most get landfilled. That silver is gone. So supply is constrained, demand is growing, and the deficit is widening. On the demand side, industrial consumption is the story. Solar panel production consumed approximately 180 million ounces of silver in 2024. That's up from 140 million in 2023. And with governments worldwide pushing renewable energy, solar installations are projected to double by 2030. That means silver demand from solar could hit 350 million ounces annually within 5 years. Electric vehicles consumed approximately 75 million ounces in 2024. EVs use twice the silver of combustion engine cars. Every EV has silver in the battery contacts, charging infrastructure, and electronics. EV sales are projected to triple by 2030. That's another 150 million ounces of annual demand. 5G infrastructure, AI data centers, medical devices, defense systems. Every high-tech application uses silver. And as technology advances, silver intensity increases. The smartphone in your pocket contains silver. The laptop you're using contains silver. The servers running YouTube contain silver. All of it locked away, non-recyclable. Investment demand is rising too. Central banks are buying precious metals at record rates, not just gold, silver too. Retail investors are stacking. Physical ETF inflows are increasing. The recognition that fiat currencies are being debased is spreading. And silver, as the affordable precious metal, is attracting capital. So we have constrained supply, exploding industrial demand, and rising investment demand. The fundamentals are screaming shortage, yet prices stuck below $30. This is the disconnect. And disconnects don't last forever. Eventually, price adjusts to fundamentals. The question is when. Here's what I'm watching for the next 72 hours, cause we're at a decision point. First, the US dollar. If the dollar index breaks above 109, that's a strong dollar environment. Silver faces more selling pressure. But if the dollar stalls at 108 and rolls over, that removes a major headwind. Watch the dollar closely. It's the primary driver right now. Second, Treasury yields. If the 10-year yield continues climbing above 4.60%, real yields stay elevated. That's bearish for silver. But if yields peak here and decline, real yields compress. That's bullish for silver. The bond market is the key to precious metals. Third, price action at $30. We're testing it again. If we break above $30 and close above it for 2 consecutive sessions, that's a technical breakout. Momentum shifts. Algorithms trigger buy signals. Traders who've been waiting on the sidelines enter. Volume increases. And we target $30.85. But if we break below $29.50, the December low, that's a technical breakdown. Momentum shifts negative. Stop losses trigger. We can sell, and we're targeting $28.70, possibly lower. The next 72 hours resolve this. We're either breaking out or breaking down. The consolidation is ending. Now, let me show you the historical context, because understanding where we are in the long-term cycle matters. Silver's all-time high is $49.82, reached in April 2011. We're currently at $29.87. That's 40% below the all-time high. For context, gold is trading within 5% of its all-time high. Copper is near all-time highs. Oil has recovered from COVID lows. Silver is the laggard. Why? Because silver got ahead of itself in 2011. The Hunt Brothers Redux, retail frenzy, speculation. When it crashed from $49 to $26 in May 2011, trust was destroyed. Retail investors who bought at $40 or $45 lost massive amounts. They swore off silver. That psychological scar lasted years, but we're 14 years past that peak. An entire generation of traders has entered markets who weren't there in 2011. The memories have faded, and the fundamentals today are stronger than they were in 2011. In 2011, industrial demand was approximately 450 million ounces. Today, it's 680 million ounces. That's 51% higher. Solar, EVs, 5G. None of that existed at scale in 2011. The industrial demand story is exponentially stronger now. In 2011, supply deficits were new. We'd just shifted from surplus to deficit. Today, we're 6 years into sustained deficits. The cumulative draw on inventories is approaching 1 billion ounces. That's massive. The fundamentals support prices far higher than $29.87. The question is when the market recognizes it. One possibility is that we in the same position gold was in 2018. Silver could be setting up for the same move, multi-year consolidation. Then breakout, then explosive rally. The pattern fits. Let's talk about what ordinary investors should be thinking right now. Because market analysis is only useful if it translates to action. If you're holding physical silver, this consolidation is frustrating. You bought at $282,930. You've watched it trade sideways for months. You're wondering if you made a mistake. Here's my take. Physical silver is insurance. It's not a trading vehicle. The fundamentals support ownership. Supply deficits, industrial demand. Currency debasement. Those factors haven't changed. If you bought physical as a long-term hold, nothing about today's price action changes the thesis. If you're trading silver, you need a plan. Define your entry, define your exit, define your risk. If you're long and we break below $29.50, you need to cut the position or accept deeper drawdown. If we break above $30 and hold, you can add, but don't hope. Don't pray. Trade the chart. If you're waiting to enter, this could be opportunity. We're at support. If we bounce from here, you're buying near the low. If we break down, you wait for the next level. But don't chase. Let the setup come to you. For context, I've been following silver since 2008. I watched the 2011 run. I watched the collapse. I watched the bottom at $14 in 2015. I watched the COVID rally to $29 in 2020. I've seen this movie before. What I've learned is this. Silver rewards patience. It punishes impatience. The explosive moves are rare, but when they come, they're violent. And they favor those who positioned early. Right now, we're in the patient phase. Consolidation, frustration, doubt. But if the pattern holds, the explosive phase is coming. Maybe weeks, months, but coming. December 30th, 2025. Silver at $29.87, below $30. Testing support. The dollar is strong. Real yields are elevated. Industrial demand is uncertain, but the fundamentals are solid. The supply deficit is real. The technical pattern is familiar. And history suggests consolidation before major moves higher. The next 72 hours matter. We're either breaking out above $30 or breaking down below $29.50. Watch the dollar, watch yields. Watch the price action, because when silver moves, it moves fast. And the setup we're in right now is identical to setups that preceded massive rallies in 2010, 2016, and 2020. I'm not telling you what to do. I'm showing you the pattern. You decide how to position, but understand this. Silver doesn't consolidate forever. And when consolidation ends, the move is usually explosive. We're at the end of consolidation. What happens next determines the entire first quarter of 2026. This is the silver update for December 30th, 2025. The setup is complete. The pattern is clear, and the market is about to make its decision. Position accordingly.